Open any trading app, scroll below the price, and there is a strip you have probably never questioned. 2 lines and a row of bars. It is set to 12, 26, and 9. It was set to that before you arrived, and it will be set to that on the next app you open. Those 3 numbers are on hundreds of millions of screens, and the explanation everyone repeats for where they came from is impossible. Not disputed, impossible. The story says 12 is 2 trading weeks and 26 a trading month, back when the week ran 6 days. New York stopped trading on Saturdays in 1952. This tool was published in 1979, 27 years later. So whatever those numbers meant to the man who chose them, they did not mean that. In the next half hour, who he was, what he was really fixing, and the part of his own method the defaults quietly deleted. Start with what the strip is, in plain language, because you cannot judge a tool you cannot describe. Everything after this depends on getting this one part right. A moving average is a smoothing. You take the last so many prices, you average them, and you plot that instead of the price. The jitter drops out. The direction survives. Do it over a short window and the average hugs the price closely. Do it over a long window and it lags behind, calm and slow, ignoring anything brief. Now put a fast one and a slow one on the same picture. When the recent past is stronger than the longer past, the fast one climbs above the slow one. When the recent past weakens, the fast one falls back through. Traders have watched for that crossing since long before computers. It is the oldest signal in the business. Appel's move was almost embarrassingly simple, and like most good simplifications, it is obvious the moment somebody has done it. He stopped drawing the 2 lines. He drew the gap between them. That is the whole invention. 1 line, and it is a subtraction, fast average minus slow average. When the 2 converge, the line falls towards 0. When they diverge, it runs away from 0. Convergence. Divergence, that is where the name comes from, and it is worth noticing that the name is a plain description of the arithmetic rather than a slogan. Nobody was doing marketing in 1979. Why is a gap better than 2 lines? Because a crossing is a yes or no event, and a gap has a size. It tells you not only which way, but how hard. 2 lines crossing tell you the moment the recent past overtook the longer past. The gap tells you it has been overtaking for a while, and by how much, and whether that is easing. Then he added a second line on top, a smoothing of the first one, a slow-moving shadow of the gap itself, trailing it. Now you have a fast thing and a slow thing again, but 1 level up, the gap, and the memory of the gap. Where they cross is the signal everybody watches. And the bars underneath, if your app draws them, are that difference drawn as height. We will come back to the bars, because a different person put them there 7 years later. So, a subtraction, a smoothing of the subtraction, and later a picture of the space between those 2. 3 pieces. Now the man. Gerald Appel was born in 1933. He started trading his own money in the 1960s, which is a sentence that hides how strange that was. In the 60s, there was no screen. There was a tape, a telephone, a broker, and the afternoon paper. If you wanted the last 26 days of a price, you kept them yourself, by hand. Somebody who wanted a moving average had to compute it, every day, on paper or later on a calculator, 1 instrument at a time. That is the constraint that shaped everything in this episode, so hold on to it. A tool that took an hour a night to maintain had to earn that hour. From trading, he moved into writing. He wrote for financial publications, and in 1973, he started a newsletter of his own called Systems and Forecasts. Note the first word, systems. Not tips, not picks, not opinions. The proposition was that you could write down a procedure and follow it. That was not the ordinary offer in 1973. The ordinary offer was a man with a view. Appel was selling something colder, a set of instructions. He also founded a firm of his own, Signalert, and ran money for clients with it for more than 30 years before he retired in 2012. Not a season, a working life. So he is not a theorist writing about markets from outside. Every tool he published was one he had to live with, on real accounts, on Monday morning. That matters more than it sounds. A tool built by somebody who has to use it looks different from a tool built by somebody who has to sell it. A tool built to be used is allowed to be awkward. It can have exceptions and different settings for different jobs because the person maintaining it knows why. A tool built to be shipped has to be tidy. One version, one set of numbers, one line in the documentation. Remember that difference? It is the whole ending. Over his career, he wrote 17 investment books, translated into a shelf of languages, and stood in front of rooms teaching seminars to a great many people who wanted the procedure rather than the prediction. He also published photography books, which tells you something about how he saw. Photography is the art of deciding what to leave out of the frame. And in 1979, in a slim monograph with a title only an engineer could love, he published the Moving Average Convergence-Divergence trading method. Nobody called it that for long. It became 4 letters, then a default setting, then furniture. To see what he was fixing, you have to feel the thing that was broken, and the broken thing is not obvious until you sit with it. Picture a rope tied to a post, and you holding the other end walking. The rope goes where you went, not where you are. A moving average is that rope. It is honest about the past and structurally late about the present. That is not a flaw you can patch. It is what an average is. Make the window shorter and the rope shortens. You get told sooner. You also get told constantly, including every time you shift your weight. Make the window longer and the noise stops. So does the news. By the time the long rope has swung, the move you wanted has largely happened. Every person who has ever tried to time anything meets this trade. Sooner and wrong more often, or later and right more often. There is no setting that escapes it. The crossover of 2 averages is one attempt at a compromise. Let the short one carry the news and use the long one as a standard to beat. But a crossover has almost no information in it. It happens or it does not. In a market drifting sideways, it happens over and over, in both directions, for nothing. Traders had a word for that decade before Appel: whipsaw. Being thrown out and back in repeatedly, each time paying the cost of the trip. So the real question in 1979 was not how to find the crossing. Anybody could find the crossing. It was how to tell an important one from a meaningless one. And you cannot answer that from the crossing itself, because at the moment of crossing, every crossing looks the same. The gap is 0. That is what crossing means, which is exactly why drawing the gap is not a cosmetic change. The crossing is one frame of a film. The gap is the film. Watch the gap and you can see the 2 averages closing on each other for weeks before they touch. The event stops being a surprise and becomes an arrival. You can also see the opposite, a gap that widens and widens and then merely stops widening while the price is still climbing. Nothing has crossed. Nothing has reversed. But the engine that was driving the thing has quietly come off the accelerator, and the gap says so first. That is the observation the whole tool exists to make available, not a signal. A rate of change of enthusiasm, drawn where you can see it. So let us build the thing, slowly, out of objects you can picture, because this is exactly the point where explanations of this tool go abstract and lose everybody who was doing fine until then. 2 buckets under the same tap. One is small and fills fast. One is large and fills slowly. Both are catching the same water. The water is the price. The small bucket is the fast average. The large one, the slow. Turn the tap up and the small bucket rises first, every time. Now stop looking at either bucket. Put a stick across them and measure only the difference in the levels. That measurement is the line Appel drew. When the tap opens hard, the difference grows. When the flow steadies, the difference stops growing and sits. When the tap closes, the difference shrinks and then goes negative. Notice what the stick does that the buckets do not. It throws away the level entirely. It does not care whether the buckets are nearly empty or nearly overflowing. It only reports the disagreement between them. And the disagreement between a short memory and a long memory is a decent working definition of momentum. There is one more piece of craft in it, and it is the sort of thing you only get from somebody who used the tool by hand. The averages are exponential. That means the newest price counts most, and older prices fade away smoothly, instead of dropping out all at once on a fixed day. A plain average has a cliff at the back. On the day an old extreme falls out of the window, the average lurches and nothing at all has happened in the market. That is a false signal generated purely by bookkeeping, and it arrives on a date decided a month earlier by nothing. The exponential version has no cliff. Nothing ever falls out. It only fades. And in 1979, there was a second reason, an unglamorous one. An exponential average can be updated from yesterday's number and today's price. That is all. You do not have to keep 26 days of history on paper. You keep one number and you nudge it. On a hand calculator, that is the difference between doable and not. So, the exponential choice is partly mathematics and partly the desk it was invented on. Almost every old tool has a piece of its own workshop stuck to it. Now the last piece. A raw difference is still jumpy because the fast average is jumpy. So he smoothed the difference and drew that too. The signal line. A moving average of a moving average gap, which sounds like a joke told at the expense of people who like moving averages, until you see what it is actually for. Here is what it is for. You now have two things on one picture, the momentum right now, and the recent habit of that momentum, sitting next to each other where they can be compared. When momentum rises above its own recent habit, something has changed in the last few days that was not true in the last few weeks. That is a far narrower claim than the price is going up, and narrow claims are the only kind a tool can honestly make. So the classic reading is the crossing of those two, the gap line crossing its own smoothing, up through and the recent has overtaken the habit. Down through and it has fallen behind. You will notice we have arrived back at a crossover, one story higher. That is fair, and it is worth being honest that the criticism lands. What has genuinely changed is that this crossover is of two quantities that both already contain the whole recent history, so it fires less often and on less trivial things. There is a second reading, and it is the one Appel's own writing spends more care on. Where is the gap relative to zero? Above zero means the short memory is above the long memory. The trend, by this definition, is up. Below zero, down. It is not a prediction. It is a label for the state you are in. And that is the useful frame. One part of the tool tells you which regime you are standing in. The other tells you whether that regime is gaining or losing energy. Same three numbers on the screen, doing two different jobs. Most of the arguments about this indicator are people using one job to judge the other. And the third reading, the one that made its reputation, is the one that needs no crossing at all. Divergence, in the ordinary English sense, price makes a higher high. The gap does not. The market has gone further on less. That has been the tool's headline claim for 45 years. Now the part I promised you in the first minute, 12, 26, 9, where did they come from? Type any of those into a search box with the word MACD, and you will get the same answer within about 2 results, phrased almost identically every time. It goes like this. The trading week used to be 6 days. 12 is 2 of those weeks. 26 is a month of them. 9 is a week and a half. It is a lovely answer. It is tidy, it makes the numbers feel deliberate, and it turns an arbitrary default into a design decision. The New York Stock Exchange held its last Saturday session on the 29th of September, 1952. Saturday trading had run from 10 in the morning until noon from 1887. When they ended it, they added half an hour to the weekday close to make up the time. Appel published this method in 1979, 27 years after the last Saturday session. He was in his mid-40s. He had never traded a 6-day week as a professional. So the explanation on every second page about this indicator describes a calendar that had been gone for a generation before the tool existed. I want to be careful here because this is the place where it would be easy to overclaim. And overclaiming is how these stories rot. I am not telling you what the numbers do mean. I looked. There is no document I could reach in which he explains the choice, and I am not going to invent one for you. What I am telling you is narrower and harder. The most repeated explanation cannot be right because of a date. That is all, and it is enough. And it is enough because of what it reveals about the object rather than about the man. These numbers were not audited, not once by anybody on the way to your screen. They were copied from the monograph into a magazine, from the magazine into the first software packages, from those packages into every package that came after. Each copy trusted the one before it. Nobody at any point in that chain had a reason to go back and check because the numbers worked well enough and the story sounded right. This is how defaults happen, not by decision, by nobody having a reason to touch them. And once enough people are watching the same default, it acquires a second life that has nothing to do with whether it was well chosen. If a large number of participants are all watching the same line on the same setting, the line stops being purely a measurement of the market and becomes a small part of it. That is not mysticism. It is the ordinary consequence of a shared instrument. A crowd watching the same clock arrives at the same time, whatever the clock says. There is a second thing the defaults did, and I find it the more interesting of the two because it deleted a piece of the man's actual thinking. The version you have is symmetric. The same three numbers do the buying and the selling, and the tool makes no distinction at all between the two jobs. One instrument, one configuration, both directions. That is not what he described. His method specified different settings for buy signals than for sell signals. A faster pair for one job, a slower pair for the other. Sit with why somebody would do that, because it is the most revealing detail in the whole story, and it takes about 30 seconds to see. Markets do not go up and down in the same way. Advances tend to be slow, broad, and grinding. Declines tend to be faster, sharper, and shorter. If the two directions have different characters, then a single instrument tuned for one of them is mistuned for the other. Obviously, once it is said out loud. So a man who had to live with his own tool on real accounts did the sensible, untidy thing. He used two settings and knew when to use which. And then the tool got shipped. And a piece of software with two configurations and a rule for choosing between them is a piece of software with a support problem. So it shipped with one. And the one it shipped with became the only one that most people have ever seen, which over 4 decades is indistinguishable from it being the only one there is. I want to be careful again. I am not saying his settings were better. I have no way to show you that, and I am not going to pretend otherwise. I am saying something you can check without any market data at all. What you were handed is a simplification of what he wrote, and nothing on the screen tells you that. That is the recurring shape of this program. Tools survive, the reasoning that came with them does not. Charles Dow's index was a working average for a newspaper column, and it is now a number read aloud on the evening news as though it were a temperature. Wilder's index arrived inside a book full of warnings about how to read it, and it now arrives on a phone with a colored zone and no warnings at all. Both. In every case, the object is faithfully preserved and the instructions are lost, because the object can be copied and the instructions have to be taught. 7 years after the monograph, somebody did go back and look at the tool properly. He is alive. He published his work under his own name, and he is worth crediting precisely. Thomas Aspray in the autumn of 1986 was using the indicator on weekly charts rather than daily ones, and he kept running into the same wall from a slightly different angle every time. The signal was late, not wrong, late. On a weekly chart, each bar is 5 days, so being 1 bar late means being a week late, and a week is a long time to be late. His first attempt is the one everybody tries. He shortened the averages. And it worked, in the sense that the signals came sooner. It also worked in the sense that everybody who has ever done this discovers within a week more signals, more of them meaningless, straight back into the whipsaw. So he stopped trying to make the tool faster and asked a better question. Could you see a crossing coming before it happened? And the answer was sitting in front of him. He already had 2 lines. The space between them was already on the screen. Nobody had drawn it. Because think about what that space does just before a crossing. It closes. It has to. A crossing is that space reaching 0. So the gap between the gap and its shadow shrinks steadily for days before the event everybody is waiting for. Visible. In advance. Every time. He drew it as bars rising and falling from a center line and published his findings as a series in technical analysis of stocks and commodities. And that is the row of bars under your price chart, not part of the original tool. An improvement by a second person who used the first person's work honestly and said so. I like this part of the story more than the invention, and I want to say why. Because it is the thing the closing act is built on. Appel's move was to look at 2 lines and draw the space between them. Aspray's move was to look at Appel's 2 lines and draw the space between those. Same idea applied to itself. The interesting thing was never in either line. It was in the distance, and the distance was always there, unrendered. Which is a general lesson about instruments, and not only about this one. Most of what a tool can tell you, it is already telling you, in a form nobody has bothered to draw. There is a smaller, sadder note in it too. The histogram is now called part of the MACD by almost everyone, including people who use it daily. Now the honest half, because an episode that only admired the thing would be an advertisement with a documentary voice on it, and that is not what this program is for. 4 limits, plainly. It lags. Not sometimes, always, and by construction, and no setting fixes it, because it is made of averages, and an average is a statement about the past. Anyone selling you a configuration that removes the lag is selling you a shorter average, which is to say, more noise, which you will pay for in trades that go nowhere. Second, it has no idea what it is measuring. Give it a currency, a share, a commodity, a made-up series of random numbers, and it will confidently produce a signal. It is a difference engine and nothing else. Feed it pure noise, and it will hand you back structure in the noise, with crossings and divergences, because subtraction always produces something. Third, and this is the one that costs people real money. It is a trend tool, and a trend tool in a market with no trend is a machine for generating losing trades on a schedule. Every whipsaw is a signal that was correctly generated by a tool being asked a question it cannot answer. And fourth, the divergence reading, the famous one, the one that gets screenshotted and posted with an arrow on it. Price makes a higher high, momentum does not, therefore reversal. Momentum can fall for a long time while price keeps rising. A slowing climb is still a climb. Divergence tells you the pace has changed, not that the direction will. Those 2 sentences are not the same sentence, and the distance between them is where a great many confident predictions have died. What the academic work says when you read it, rather than the summaries of it, is that results depend enormously on which market, which period, and which rules. Which is a polite way of saying, it is an instrument, not an answer, and an instrument in the wrong hands returns exactly what it was asked for. I am not going to give you a number for how often it works, and I want to be plain that this is a refusal, not an oversight. Any such number would come from a specific market over a specific stretch of years, and quoting it to you would be a recommendation wearing a statistic as a costume. What I can tell you is what it measures, which I have, and what it cannot see, which is everything that is not in the price. It does not know about earnings, or a rate decision, or a fire at a factory. It knows the last few weeks of one number. That is the entire universe it lives in. So why is this specific tool, out of the hundreds published in that era, still on the default screen of every application 45 years later? Part of the answer is genuinely that it is good. It is cheap to compute, it is hard to misread badly, and it says one clear thing. But the larger part of the answer has nothing to do with quality, and it is duller, and it is more important, and it is close to the reason this program exists at all. It arrived at exactly the right moment. In 1979, the first personal computers were reaching desks that had never had one. Software authors needed things to compute. A tool that could be updated from yesterday's number and today's price was ideal for a machine with almost no memory. So it went into the packages early. And once it was in the packages, it was on the screen. And once it was on the screen, it was what people learned on. The people who learned on it wrote the next generation of software and put it in, because that is what an indicator list looks like. The tool did not win an argument. It won a place in a menu, and then the menu was copied for 45 years, which is worth knowing the next time you see a list of indicators and assume it is a ranking. It is a fossil record. The things at the top of that list are not the best tools available. They are the tools that existed when the first lists were written. Appel himself kept working long after the tool escaped him. 17 books, a newsletter he ran from 1973, seminars, 35 years of client money. He retired in 2012. He died in February 2020 at 86, and his son had by then taken on the family firm. Almost nobody who uses his indicator every day could tell you his name. I would guess that is true of most of you before this episode, and that is not a criticism. It is the ordinary fate of a successful tool. It stops being somebody's idea and becomes part of the furniture, which is the highest and loneliest thing an invention can do. A photographer would have understood it. You compose the frame, and if you have done it well, nobody looking at the picture thinks about the frame at all. So, what do you actually take away from this other than a name you did not have an hour ago? 4 things, and none of them require you to buy anything. 1. When a tool arrives with numbers already in the boxes, find out where the numbers came from before you trust them. Here, the answer turned out to be nobody knows, and the popular story is impossible. That is not a reason to distrust the tool. It is a reason to know which parts of it were designed and which parts were merely inherited. 2. Ask what any indicator is a function of. This one is a function of price and nothing else. So it cannot see anything that is not in the price, and it never could. So next time you meet a dashboard, ask yourself that one question before you trust it: what goes in, and therefore what can never come out? It takes 2 minutes, and it has saved people a great deal. 3. Separate the state from the change. This tool tells you which side of zero you are on, and separately whether the momentum is gaining or fading. Most disagreements about it are people arguing about one of those readings while looking at the other. That confusion is not unique to charts, and noticing it is a genuinely portable skill. 4, and this is the one I would keep. Look for the space between the lines that somebody has already drawn for you. Apple did it once and got an indicator. Aspray did it to Appel's output and got the bars. In both cases, the information was already on the page, and the invention was the decision to render it. So look for it. You can almost certainly find a report or a spreadsheet in your own work with 2 lines on it that nobody has ever thought to subtract. So, to put the whole thing in one sentence, what is on your screen is a fragment of somebody's working method, with the exceptions filed off and 3 unaudited numbers in the boxes. Knowing that does not make you a better trader. It makes you a more careful reader of instruments, and that transfers to everything. Next week on The Toolmakers, a man who is still alive to argue about it, and whose tool has his surname printed on it in every application on Earth. John Bollinger and the bands that carry his name. He built them to answer a question nobody was asking in the early 1980s. Not where is the price going, but how much room is it currently using? And unlike this week, we have his own explanation of every choice, in his own words. That turns out to make the story stranger, not simpler. Follow the channel, and I will see you then.